The world of hedge funds is very interesting as organizations try to different structures in order to get that elusive alpha. Fund managers across the world are struggling with different asset classes, multi assets, multi currency markets in different assets like commodities, bonds, interest rates in different currencies like EUR, JPY, GBP, etc., in search of that alpha. The past 1 year has not been very kind to the hedge fund industry because of the volatility in the markets and the global economy struggling with inflation. In this time frame, hedge funds have come up with a structure which has been quite popular in the mutual fund industry, and that is called as the fund of funds. Let's take a look at what is the structure, or what is an understanding of the structure of a fund of funds with respect to hedge fund industry. Most of the terms are quite familiar with us now. General partner, hedge fund structure like a trust, there's a limited partner, there are allocations, there's fund management, there's partnership, etc., which also is there in fund of funds. So let's analyze what is a fund of funds. A fund of funds is a structure wherein the hedge fund invests in other hedge funds, okay? Or it could invest in mutual funds, or it could invest in private equity firms, or sometimes even in real estate investment trusts. So the fund of funds might make an asset allocation across all these asset categories. So the fund is investing in other funds, okay? And that's a very novel concept because over here we're struggling with getting asset returns. So then what is the objective of a fund of funds trying to invest in other funds? So the fund manager of a fund of funds is actually investing in the fund manager's capabilities of other funds. And because the fund of funds is in the hedge fund industry, it will typically invest in other unlisted hedge funds or mutual funds or private equity funds. So the structure is very complex in a fund of funds. And therefore, when I looked around and saw whether all hedge funds offer a fund of funds structure, I found that no, not really. Unlike in mutual funds, where there are many mutual funds which offer an FOF structure, in the hedge fund industry, this has not been very popular, though there have been quite a few funds which have achieved success with this FOF structure. General partner is the firm that manages the funds. So this is the partnership agreement between the general partners and the limited partners, and the general partners collects capital from the limited partners. It has the full and complete management control and is responsible for asset allocation, portfolio management, tactical strategies, etc., which result into profit generation of the hedge fund. The limited partners contribute only capital into the fund. There is no management control, and their liability is limited to the extent of capital that is contributed. But a hedge fund is all about capital, right? I mean, it's about fund management. So you're managing funds. So without limited partners, a general partner can't even start a hedge fund. But the limited partner exercises control only to the extent of uh, performance failures or not getting good enough returns. They don't interfere in the day to day operations of the hedge fund, which is what the general partner does. So there's an agreement between the GP and the LP called the LPA, that's the Limited Partnership Agreement, about which we'll be discussing in another video. Suffice to say, at this point of time, limited partners contribute to the capital of the fund. This could be There could be multiple limited partners if there's an LP1, LP2, LP3, which invest in the fund of funds. The fund of funds is like a general partner. They pool the capital that is sourced from multiple limited partners, and collectively they invest this capital in different funds. So the fund of funds is a very peculiar structure which looks at analyzing and investing in other funds because they want to get a better return. This fund of fund structure is therefore also called as a multi-manager. Okay, you've heard of multi-asset funds, you've heard of multi-currency funds. Now we have multi-manager funds. Why is it called multi-manager funds? Because Each of the hedge funds, mutual funds, or private equity funds also have their own fund manager, right? So, in a sense, the fund of funds manager is investing in the management capabilities, the investing capabilities, the asset allocation strategies, and the portfolio management methods of each of the other funds. And hence, a fund of fund structure is also called as a multi-manager fund. Okay, so if in case somebody asks a question, what is a multi-manager fund? The answer would obviously be that it is a fund of funds. And why is it multi in nature? Because each of the entities, that's the fund of funds, has its own fund manager. The fund of funds then invest in hedge funds, which have their own fund managers. The mutual funds have their own fund managers. The private equity firms have their own fund managers, and therefore it's called as a multi-manager fund. The investing style of hedge funds could be strategic or tactical. Strategic means it's a passive style of investing. Why is it called passive style of investing? Because they have decided asset allocation very early on at the time of capital contribution, and to a large extent during the lifetime of the fund, they will stick to that strategy. Okay, they will stick to that asset allocation that they have decided. The strategic asset allocation is a passive style because it doesn't want to change during the course of the funds. On the other hand, the tactical asset management or tactical investing strategy is one that looks to grab opportunities, to take on incentives, to take on turbulences, to take on turmoils, to take on other upheavals which economies go through, and therefore the tactical fund management strategy is called as an active management strategy. What do you think? Fund of funds, what do you think? They follow strategic asset management, or do you think they follow tactical asset management? From my analysis of whatever the fund of funds, especially in the hedge fund industry, have done, is they are tactical investors. The reason why they're investing in other funds, remember they're not investing in other asset classes, they're investing in other funds, is because they want to grab that opportunity. They want to take advantage of turbulences and turmoils. They want to take advantage of the different strategies that the hedge funds, the mutual funds, the private equity firms, the real estate investment trusts are taking. And therefore, fund of funds are investing in a style that can be described as tactical investment strategy. The fund of funds are also categorized into two, fettered or unfettered. Now, this is a very unique term which I find is used only in the FOF structure. The FOF structure, because it invests in other funds, has an opportunity to invest in funds that are raised by other hedge funds or by the own family of hedge funds. And therefore, if the hedge fund invests only in other funds promoted by its own parent sponsor, it is called as a fettered hedge fund. On the other hand, an unfettered hedge fund is one that can invest in any other hedge fund irrespective of the parentage. So if a question arises as to, why would a hedge fund want to invest in hedge funds that are promoted by its own parent company or by its own sponsor, the answer is very obvious, because of the principles of tactical diversification, right? And at the same time, allowing the capital to stay within the family of hedge funds. So unfettered is allowed to invest in any other asset class or any other hedge funds that are promoted by any other GP. Okay, whereas fettered would be looking at investing in only other funds that have been promoted by the same family. Let's relook at the fund of funds structure. As you know, the fund of funds invest in different hedge funds, mutual funds, and private equity funds. And each of these funds, that is the hedge funds, the mutual funds, and the private equity funds, have their own management fees plus incentive fee structure, which the fund of funds will be paying, right? Because it's an investor into each of these funds. And therefore, in a fund of fund, the fee structure is two-layered. That is the fees of the underlying fund investment as well as the fees of the fund of funds. This is a very unique concept. So the cost doesn't increase. In fact, it decreases. The fund of funds is not able to charge as much active management fees or incentive fees as the hedge funds or the mutual funds do, because they have a two layers. In fact, they're paying for the investments that they have made, they're paying that performance fee as well as the management fee. And then they're collecting from their LPs, they're obviously having to justify what is the explanation as to the two layers of fees. Keeping that in mind, keeping that in cognizance, they will therefore charge a much lower fee structure compared to what other hedge funds would typically charge. Thank you so much for listening in. If you're interested in a career in global markets across operations, processes, regulations in trade lifecycle, fund accounting, OTC derivatives, and custody operations, please subscribe to my YouTube channel. I am Sushila Hariharan, thanking you.